Understanding cash flow. Cash flow refers to the movement of money into and out of a business. It is an essential indicator of a company's financial health, as it reflects the ability to meet short-term obligations and sustain operations. A positive cash flow means that the business is bringing in more money than it is spending, while a negative cash flow indicates that expenses exceed income. 1. Types of cash flow. There are three main types of cash flow, each representing a different aspect of the business's financial activities. Operating cash flow, OCF. This is the cash generated from the company's core business activities, such as sales of products or services. It excludes external financing or investments. Formula for operating cash flow. Operating cash flow net income, non-cash expenses, changes in working capital non-text. Operating cash flow is text net income plus text non-cash expenses plus text changes in working capital. Investing cash flow, ICF. This refers to cash flows associated with the purchase or sale of long-term assets such as property, equipment, or investments. Examples: buying or selling assets, acquiring new investments, or lending money. Financing cash flow, FCF. This represents the cash flows between the company and its investors or lenders. It includes actions like borrowing funds, repaying debts, issuing stock, or paying dividends. Examples: issuing new shares, paying dividends, taking loans, or repaying debt. 2. The importance of cash flow. Liquidity management. Cash flow management ensures that a company has enough cash to cover its operating expenses such as payroll, inventory, and rent. Investment planning. Positive cash flow allows a business to reinvest in its operations, buy new equipment, expand facilities, and invest in new projects. Debt management. Proper cash flow ensures that a company can meet its debt obligations on time, avoiding penalties or damage to creditworthiness. Financial health. Cash flow is often considered a more reliable measure of financial health than profits, as it reflects the actual ability of a business to manage its finances. Cash flow statement. A cash flow statement provides a summary of a business's cash inflows and outflows over a specific period. It is typically broken down into three sections. Operating activities. This section shows cash generated or spent by the company's day-to-day business activities, such as sales of products or services and payments to suppliers and employees. Investing activities. This section details cash inflows and outflows from investments in long-term assets, such as buying or selling equipment, real estate, or securities. Financing activities. This section includes cash flows resulting from transactions with the company's creditors and investors, such as borrowing funds, repaying loans, or issuing shares. 1. Structure of a cash flow statement. A well-structured cash flow statement will show net cash flow, the total amount of cash a company generates or uses during the period. Cash flow from operations, the difference between cash inflows and outflows from core business activities. Cash flow from investments, the cash inflows or outflows resulting from asset purchases or sales. Cash flow from financing, the cash flow related to borrowing or repayment of loans, issuing stock, and dividends. Cash flow forecasting. Cash flow forecasting is the process of estimating future cash inflows and outflows for a business. It helps businesses plan for upcoming financial needs and avoid cash shortages. Accurate cash flow forecasting is essential for making informed decisions about spending, investments, and financing. 1. How to prepare a cash flow forecast. A typical cash flow forecast will include projections for each of the following: cash inflows, projected revenue from sales, accounts receivable collections, loans, investments, etc. Cash outflows, expected expenses such as operating costs, loan repayments, salaries, and equipment purchases. 2 key components of a cash flow forecast time period. A cash flow forecast typically covers weekly, monthly, or quarterly periods depending on the nature of the business. Sales projections estimate the amount of revenue expected to be received during the forecast period. Expenses include all expected outflows such as rent, utilities, salaries, and any other recurring costs. Net cash flow, the difference between inflows and outflows. A positive net cash flow indicates that the business is generating more cash than it is spending, while a negative net cash flow means the opposite. 3. Best practices for cash flow. Forecasting. Be conservative with revenue estimates to avoid overestimating cash inflows. Include a buffer for unexpected expenses such as repairs or sudden market fluctuations. Review and update the forecast regularly to reflect actual performance and any changes in business conditions. Working capital management. Working capital is the difference between a company's current assets, like cash, accounts receivable, and inventory, and current liabilities, like accounts payable and short-term debt. Effective working capital management ensures that a business can maintain smooth operations without running into cash flow issues. 1. Components of working capital: current assets. Assets that are expected to be converted into cash within 1 year, such as inventory and accounts receivable. Current liabilities: debts or obligations due within 1 year, including accounts payable, short-term loans, and accrued expenses. 2. The importance of working capital: operational liquidity. Proper working capital ensures that a business can pay its short-term liabilities and continue operating without interruption. Business growth: a sufficient working capital balance allows for reinvestment in inventory, equipment, and hiring new staff. Risk reduction: insufficient working capital increases the risk of bankruptcy or financial distress. 3. Managing working capital. Effective working capital management can be achieved through optimizing inventory. Avoid overstocking inventory to reduce holding costs, while ensuring that there is enough stock to meet customer demand. Accelerating receivables. Speeding up the collection of accounts receivable to improve cash inflows. Managing payables. Negotiating favorable payment terms with suppliers to delay cash outflows without damaging relationships. Strategies for improving cash flow. 1. Reducing costs and expenses. Cutting unnecessary expenses. Review and eliminate any non-essential costs to reduce cash outflows. Negotiating better supplier terms. Work with suppliers to extend payment terms or negotiate discounts for early payments. 2. Increasing revenue, diversifying revenue streams. Explore new products, services, or markets to increase revenue and reduce dependency on a single source of income. Improving sales collection. Ensure timely collection of accounts receivable and avoid late payments. 3. Financing options. Short-term loans or lines of credit. Use short-term loans or lines of credit to cover temporary cash shortfalls. Equity financing. Raising funds through the sale of stock or ownership in the business can provide additional cash for growth or emergencies. 4. Cash flow cushion building. A cash reserve. Maintain a cash reserve or emergency fund to help cover unexpected costs or cash flow shortages. Conclusion and summary. In Module 6, we have explored the fundamental aspects of cash flow management, including the types of cash flow, the importance of cash flow forecasting, and strategies for managing working capital. Effective cash flow management is crucial to maintaining the financial health and sustainability of a business. By understanding and actively managing cash flow, businesses can ensure they have the liquidity needed to operate smoothly, invest in opportunities, and weather financial challenges.